Hey everyone, and welcome to The Explainer. I am so thrilled to have you here because today we're diving into some absolutely crucial information that is impacting fixed-income seniors across the country right this very minute. We're looking at a brand new, highly detailed financial report that exposes a massive wave of unexpected IRS bills suddenly hitting mailboxes. And we're going to connect those personal mailbox surprises to a really huge long-term projection regarding the entire future of Social Security for retirees. There is a lot to unpack here, so let's just jump right into the data and make perfect sense of the whole shebang.
So, let me ask you a quick question. Is tax season actually over? Because, if you filed back in April and finally breathed that huge sigh of relief, well, the source material we're looking at today suggests you might actually be in for a bit of a shock. As we hit the end of May, instead of getting those refunds they were eagerly waiting for, millions of seniors are opening their mailboxes only to find unexpected, massive surprise bills coming straight from the IRS. It's creating a very real panic at the end of the month, and we really need to understand exactly what these bills are.
Okay, let's dive right into this. The data shows us that there are three specific types of financial hits retirees are getting slammed with right now. We're talking about underpayment penalties, Medicare surcharges, and back taxes on retirement withdrawals. Listen, these aren't just minor clerical errors. These are substantial, multi-layered bills hitting fixed-income seniors who genuinely, honestly believe their tax obligations were completely settled for the year.
Part 1. The Underpayment Penalty Trap.
To really understand how millions of people fell into this situation, we've got to break down the mechanics of this complex bureaucratic issue. Because it all starts with the IRS computer system scanning senior tax returns and automatically issuing thousands of these specific penalties. Here is the exact three-step sequence of events that triggers this trap. First, a lot of retirees pulled money out of their 401ks, pensions, or investment accounts last year. Why? Well, analysts point out they did this simply to combat inflation and keep up with rising daily costs. Second, and here's where the simple misunderstanding happens, they assumed the taxes on those withdrawals were being automatically withheld, but they weren't. Finally, step 3. Because these retirees didn't actively prepay enough estimated taxes on those withdrawals throughout the year, the IRS algorithm flagged the underpayment and just automatically generated a penalty notice.
Now here is the absolutely crucial part, the sheer urgency of the situation. Financial analysts are warning that this isn't just some flat fee sitting on your desk. There's a daily interest penalty attached to this underpayment, and that interest starts compounding the literal second you open the envelope. The algorithm doesn't take a break, it just keeps adding to your balance every single day you delay taking action.
Part 2. The tax deduction domino effect. Now, as stressful as that situation in your personal mailbox is, we need to zoom out for a second. We're transitioning from this micro issue to a massive macro issue that's currently unfolding in Washington. Over the last month, findings reveal that millions of seniors successfully utilized a new, totally legal $6,000 senior tax deduction, and this deduction successfully lowered the final IRS bills for a massive number of retirees. Now, on an individual level, keeping an extra $6,000 sounds like an absolute victory, right?
But the objective consequence of that victory really just comes down to simple math. Because seniors are legally paying less in taxes thanks to this deduction, the federal government is collecting drastically fewer tax dollars overall. That revenue simply isn't coming through the door anymore.
To understand why that missing revenue is such a big deal, we need to define exactly where those tax dollars were supposed to go. The Social Security Trust Fund. This is the federal account specifically designated to hold tax revenues, and those exact revenues are what's used to pay out monthly survival checks to beneficiaries. The really terrifying consequence revealed in the recent analysis is that the tax dollars saved by that $6,000 deduction were originally supposed to go directly into this very trust fund.
Part 3. The 2032 Social Security Threat.
And that brings us to the future projections regarding the long-term solvency of the entire system. You see, this current drop in tax revenue isn't just a temporary hiccup. It is an active, accelerating threat to Social Security. To impartially show you just how severe the warnings are right now, take a look at this direct quote from the data. Analysts state that this deduction is, quote, starving the government of revenue, pushing the Social Security system toward a 28% benefit cut. The experts are making a direct correlation here. The cash shortage caused by less tax revenue is pushing the trust fund closer and closer to the brink of total insolvency.
Basically, if Congress doesn't step in to fix this cash shortage, projections show the government will be forced to implement a mandatory 28% cut across all Social Security and SSDI checks. Let that sink in. That means retirees would only receive 72% of their expected benefits. And the data notes this could happen as early as the year 2022.
When we place these two facts side by side, the trade-off becomes crystal clear. And honestly, there's a deep irony here. Seniors were given a $6,000 tax break today, sure, but that very same tax break is setting the stage to slash their monthly survival checks by nearly 30% in just a few short years. It's a profound short-term gain that's resulting in a very severe long-term consequence for the trust fund.
Part 4. Action Plan and Next Steps.
So what do you do with all this information? Let's shift from the macroeconomic data right back to your personal situation. If you check your mail this week and find one of those underpayment penalty notices, the experts recommend a very clear 3-step action plan. Step 1, do not panic and rip it up, but also definitely do not just pay the penalty blindly. Step 2, take that notice to a tax professional immediately.
Step 3, and this is the vital takeaway, actively ask that professional if you qualify for something called a first-time penalty abatement waiver. There are mechanisms in place to fight these compounding penalties, but you absolutely have to know to ask for them.
As we wrap up the explainer today, I want to leave you with this final, truly critical question raised by the findings. Are short-term tax deductions worth long-term Social Security risks? It's the ultimate trade-off, and we are watching it play out in real time right now between our personal tax returns and the federal trust fund. We are definitely going to continue tracking this ongoing crisis and the structural health of these programs. Thank you so much for learning with me today. Stay vigilant with your mailboxes out there, and I will see you next time.